Joining us now is Saira Malik, CIO of Nuveen, which has over $1 trillion in assets under management. Saira, it's great to have you back on the show. That is where I want to start with you, is expectations for the commentary we get from Powell tomorrow, given the fact that we've seen the long end of the yield curve move so dramatically, so quickly.
Well, markets were generally pleased with other Fed speakers over the last week or so, where comments have been dovish and they've been talking about perhaps taking future rate hikes off the table. I expect Powell to come in a little more hawkish tomorrow. Inflation is still an issue. The employment markets are still strong. The consumer is still spending. I think all of that together makes him lean a little bit more hawkish. Our expectation is for one more rate hike on the table before the year ends. But with 10-year yields almost hitting 5% levels, they may be doing the work for the economy in terms of tightening that rate hikes would be doing. But I think Powell is still going to be conservative and leave the door open to one more rate hike before the year ends.
Okay, there's a lot of macro factors at play here for investors, whether it's what the Fed does and what the economic data shows us and inflation, or obviously geopolitics, all of the uncertainty and risk there. That's always so hard to price into the market. You balance that against earnings season, which so far has been pretty good. I mean, look no further than Netflix this hour, spiking by double-digit percentages. How do investors navigate the macro versus the micro?
Well, investors have a host of macro and micro issues to contend with, ranging from geopolitical issues, earnings, 10-year yields, and the economy. So starting with geopolitical issues, those were taking center stage today. Investors were cautious, worried that the conflict in the Middle East may start to expand. In return, that causes oil prices to increase, and that could tilt the global economies into a recession. That's not our base case, but it is a fear that's out there and very valid. For earnings, I think this is going to be the quarter that ends the 3 quarters of negative earnings growth that we've seen for earlier this year. I think earnings are going to beat and raise in general, led by technology stocks. Looking at yields approaching 5%, that could lead to the tightening of the economy that finally tilts us into recession. And then, of course, the economy as of now is quite strong, led by the consumer, led by employment markets. But if you take a closer look at the consumer, you are seeing some stress there. Auto and credit card debt is rising significantly. I think eventually this consumer spending that we're seeing will start to roll over.
Saira, yeah, I mean, speaking of yields, you guys at Nuveen have a whole lot of bond funds. And I think the popular wisdom at the beginning of the year was, oh, the Fed doesn't have that much farther to go but on rates. But yields are up a lot, despite what the Fed has or hasn't done. So what's the message now for investors who have been eyeing bonds and thought that maybe what happened this year wasn't going to happen?
Well, investors have been holding a lot of their portfolio in cash, about 25% of portfolios in cash, earning about 5% on T-bills and CDs. And for investors to leg out of that cash, they need to find returns that can beat the risk-free cash returns that they can get. You can find that in fixed income in certain areas that have been hit hard and are earning returns that are greater than 5%. So municipal bonds, the fundamentals remain very strong there. The state savings rates, their coffers are at very high levels. Rainy day funds are very high. They're in good shape fundamentally. I think you can invest in AAA and BBB munis and earn a nice return there. Switching over to equities, you can also earn income there. A segment of the market that's been left behind is dividend growers. These are companies that consistently increase their dividend yield. As the Fed starts to put rate hikes behind us, I think these companies in equities that provide income to investors will also be important. And that will help investors get out of cash, because once the Fed pauses on rate hikes, the return on cash will start to decay. So you want to be careful about holding onto that cash for too long.
What do you say to investors who are getting nervous seeing bond prices head down as yields go up? You know, it's hard for people to be patient, but any historical perspective on why, for example, what you were saying about munis makes sense?
Well, this is going to be a continuous short-term issue as long as the 10-year and the yields keep moving up the rate that they have been. Our view is, though, this will start to settle as the Fed gets to its final rate hike. This is also tightening the economy pretty significantly. So given that, we do expect to see the consumer slow and U.S. growth eventually to start to slow down as we go into 2024. I think that'll start to unwind some of what we've been seeing year to date.